Well, hello and welcome to the SBDC introductory video on understanding financial statements for your business. I'm the moderator for today's discussion, Scott Fidel with Washington State University Extension. Now, if you haven't already done so, you can download a document from the SBDC website that covers the material we will be discussing. We have a panel of 3 certified business advisors from the Washington Small Business Development Center Network here with us today. So let me first introduce them to you. Our panelists are Terry Corneliuson, who's based in Pullman, Rick Thorpe, who's down here from Spokane today, and Tracy Stark, who's joining us from Mount Vernon. Our panelists will be discussing understanding financial statements, including the balance sheet, the profit and loss or income statement, and the cash flow statement. Each statement depicts a different aspect of the overall financial picture of a business. So to begin with, Tracy, how about starting us off today by explaining why understanding this information is really so important for a business owner?
Well, first of all, we understand that as a business owner, the day-to-day operations typically take up most of the business owner's time and energy, and that tracking their financial statements is not the reason they typically went into business in the first place. But we hope that this presentation will help simplify this process and help the business owner understand how they can monitor their financial statements and what the financial statements are saying about the performance of their business.
Okay, so as a business owner, I'm committed to digesting the information that we're going to deliver here today. What do I get back?
Well, the data in these financial statements typically show what has happened, but this is great information for the business owner looking forward and can help them make decisions for the future. It also indicates what they have performed compared to what their plans were, what their actual performance was compared to their projected performance. It also looks at what's changing, what's going right in the business, what's going wrong in the business, where are there opportunities that they should take advantage of, and where are there changes that should be made.
Okay, thank you, Tracy. So hopefully we've given our viewers some motivation for sticking with us and going through the rest of today's video. Now let's get down to talking about some of the critical statements that I mentioned in the introduction. Rick, we're going to turn to you now and ask you to take us quickly through the balance sheet. I realize we're going to spend more time today on the income and cash flow, but start us off by talking about the balance sheet. What is it and why it's important?
Okay, the balance sheet is basically a list of assets, which is on one side, and a list of liabilities on the other side. The assets are basically the things that you own or are trying to own, and the liabilities are the things that you're paying for, loans, things like that. And the difference between the two is your equity. In other words, how much you own of the company, how much you invested in it, and how much of your earnings are kept in it. The equity can be negative or positive. Unfortunately, you want to keep it positive. You look at it about once a year. The bank certainly wants to see it if you're going to get a loan, or if you already have a loan, they want to see it fairly often. And it's a way that if you're going to sell your business, you really want to start planning using the balance sheet 5 years ahead of time to get it in shape for selling your business.
Good. Well, thanks for that overview of the balance sheet. Now let's look at the other critical statements that I talked about in the beginning, and I'm going to move to Terry now. And Terry, how about starting us off by giving us a better understanding of the importance and really the components of the income statement?
Okay, my pleasure, Scott. The profit and loss statement or the income statement are actually the answer to the question, how are you doing, or how is your business performing in terms of revenue, expenses, and profit. Also, it's a tool that can be used to project your business in the future and plan for growth. It's a statement that covers a specific period of time, usually a month or a year. And the basic formula for a profit and loss statement is pretty simple and straightforward. It's sales less cost of sales, less overhead or operating expenses, and that leaves you with profit. Right? Now, to just go into a little more detail, if you start with sales and think about a business, for example, if your business has more than one product, maybe a bookstore, you'd want to enter the sales for each product or service on an individual separate line. So in the case of a bookstore, you may have sell books, but also have an espresso bar in your store. You put the sales of the books on one line and the sales of coffee on another line, add them together, giving you total sales. Applying the same principle to cost of sales, you would put the cost of books for sale on one line, the cost of coffee on another line, add them together, you've got total cost of sales. Subtract your cost of sales from your total sales, and that leaves you with gross profit. Gross profit is what you have available to cover your overhead or operating expenses. Now, these are the kinds of expenses that go on every month for a business, whether you make any sales or not. They're things like advertising, insurance, payroll, rent, utilities. Also, if you borrowed money for your business, then you'll want to put your interest expense into this category. You total all of your operating expenses, subtract those from your gross profit, and that's going to leave you with what is called net profit before taxes. Then you calculate your taxes and send that check to the government, and that'll leave you with, subtract it from your net profit before taxes, that leaves you with profit, which is your bottom line.
Okay, good. Sounds pretty straightforward.
Yeah.
But I know that it's, again, this managing this day-to-day operation is not something that business owners are really that comfortable with. It isn't why they got into it. So Rick, you and I were talking earlier about this, and you mentioned that for years you've actually been using with clients a pretty simple method, you think, to manage their income statements. Talk about that a little bit.
Yeah, and it's true that it takes a long time to read the financials, and most business people don't have time to do all that. So what we've done is what's called management by percentages. So you take two equal periods of time, like year to date for the previous year and year to date for the current year, and you do a ratio compared to sales for each, and then you're just looking at the percents and down the row. And if you see a percent that is out of whack, then you track back the numbers to see if something's wrong. But most of the time it will just simply be in line, and you'll know everything's okay. And it takes 10 to 15 minutes, and then you're off getting out on the floor and doing what you do.
Sounds like a pretty quick and simple way to take a snapshot of this when you need it. So now, from our conversation so far, again, from your perspective as advisors, it's pretty clear to me that most clients that you work with are really interested in that profit statement anyway. That's really what they're there for. But from our discussion so far, it's pretty clear that the next statement we're going to talk about is probably the most critical thing we're talking about in the entire video today, and that's cash flow. So Tracy, what is cash flow and why is it so important?
Well, you've probably heard the term cash is king, and for obvious reasons, business owners need cash to operate their business. And the cash flow statement is answering the question, where's the cash coming from and where's the cash going? And so I like to break down the cash flow statement into two sections, sources of cash and uses of cash. And I like to look at it as simply as one might manage their checkbook. Sources of cash get jotted down when a deposit is made and when cash is coming into the business. Uses of cash, withdrawals, checks that are written. And at the end of the day or at the end of the week, you have an idea of what your cash balance is. So we can go into a little bit more detail in each of those. Sources of cash is coming from the revenues that you're collecting. The receivables are an important piece of this, and it's very important to manage the aging of those receivables. Other cash that's coming into the business might be in the form of a line of credit that you withdraw from, other owner equity that's being invested into the business, or other debt that's being invested into the business. That gives you your total sources of cash.
Now, before you go into the uses, you mentioned that you used the term aging of receivables. Mm-hmm. Now, I'm not sure everybody understands what that is, so why don't you explain that a little more?
So aging of receivables is important because for some businesses, when a sale is made, the cash isn't immediately recognized. So in a retail environment, for example, when a sale is made, the cash comes in right then. It's pretty straightforward. In other businesses, when sales are made, sometimes those revenues aren't collected for 30, 60, and sometimes 90 days. So it's very important to manage that aging so that the business owner understands when that cash comes in and when it becomes available for the business to use in its operations.
Okay.
So in looking at the uses of cash in more detail, we're looking at things like your general and administrative expenses. We're looking at loan payments that have to be paid back, cost of goods sold, your accounts payables, B&O taxes, other taxes that are due, and hopefully payments to the owners. And all of these are uses of cash. Balancing those against your sources of cash will hopefully give you positive cash flow at the end of the period. And this result ultimately is what drives the business owner to make many of its operational decisions, such as when it can pay its bills, if it needs to push harder to make collections of their receivables, and et cetera.
Well, I think I now for the first time can truly say I understand what that phrase means when they say cash is king. Obviously, this is the critical component to operating a business. Now, getting down to the bottom line, again, we realize that poring over your financials isn't nearly as much fun as closing deals or developing new products, but it is a necessary discipline, and doing it right, using the information the statements contain can give you an important lever on managing your business towards success and growth. Before I close, I'd like to thank our three great panelists from the Washington Small Business Development Centers, Terry, Rick, and Tracy. We appreciate you taking the time to be with us today and help the small business owners who are watching this video to better understand the basics of their financials. And I want to again encourage everyone watching to go back to the SBDC website to get access to a lot of information about resources, great tools, and of course, information on contacting your nearest SBDC certified business advisor. And be sure to take advantage of the other training videos we have online at this site.